Welcome to The Deep Dive. We're your shortcut through complex earnings calls.
Glad to be here.
Today, we are really digging into the Q3 fiscal year 2025 earnings call for Optical Cable Corporation, OCC.
Right.
And look, if you saw the stock chart after this report, you know this wasn't just another quarter.
Not at all. A huge reaction.
Yeah, the results landed, and the market basically roared its approval. Shares shot up. It felt like a real validation, like investors are saying, okay, the strategic shift, it's working.
Absolutely. It's a massive signal. Our job today is to unpack why. What exactly in that call drove that confidence?
Let's find those nuggets.
That market move tells a story, doesn't it? For a company like OCC, a specialty player, going from losing money consistently to actually making a profit? Well, it's huge.
Than just numbers on a page.
Exactly. It validates all that restructuring, holding on to key assets during leaner times. This quarter, you really saw the potential shine through.
Okay, so let's hit the headlines first. The numbers that sparked the initial excitement. Net sales came in at $19.9 million.
Which is what, 22.8% growth year over year? Pretty strong.
Yeah, 22.8% up from last year, and also a decent 13.5% bump from just the previous quarter, Q2. So good momentum.
But that wasn't the main event, was it? The real fireworks were around the bottom line.
Right. The profitability. That was the pivotal news. OCC reported GAAP earnings per share of 7.
So about $63 million in actual net income. And you have to remember, last year in Q3, they lost $2.20 a share.
Wow. Okay, so not just breaking even, but a decisive move into positive territory. It shows that sales growth is actually hitting the bottom line now.
And management really hammered that point home on the call. The CEO basically said, look, that strong 22.8% sales growth, that's what drove this massive 61.2% jump in gross profit.
Whoa, 61.2%. That's way more than the sales growth. That's leverage.
That is textbook operating leverage in action. And honestly, this is where we need to spend a bit of time because it's the heart of the story right now.
Okay, explain that leverage.
That's 61.2% growth in gross profit. It's proof that they've scaled past their fixed cost base. All that infrastructure is finally paying off with higher volumes.
So break down the margin expansion itself. Just how much did it improve?
Oh, it was sharp, really sharp. Gross margin hit 31.7% this quarter.
31.7. Okay, and where was it before?
Well, compare that to just 24.2% in the same quarter last year. That's a huge leap.
Yeah, massive.
And maybe just as important, it was also up sequentially from 30.4% in Q2. So the trend is positive quarter over quarter too.
So it's not just selling more stuff. Each dollar they sell is generating a lot more profit now. Management said this was down to production efficiencies from higher volumes. What does that actually mean on the factory floor?
Well, think about it. Companies like OCC, specialty manufacturers, they made a twinge during the tough times. They kept their core machines, their buildings, their key technical people.
Those are fixed costs. They don't change much day to day.
Exactly. Rent, depreciation, core engineering salaries. Those costs are there, whether you're running the plant half empty or full tilt. When sales were low, those fixed costs were a huge drag on margins.
Makes sense.
But now, as sales volume picks up, that extra revenue covers those fixed costs much faster. And then, every dollar after that, it drops to the gross profit line much more efficiently. High velocity profit.
Okay, that clicks. And it makes the discipline on the admin side, the SG&A, even more critical, right?
Yeah.
Sales up nearly 23%. You'd expect overheads to jump too?
You would absolutely. Commissions, shipping, general admin. But they kept a tight lid on it. SG&A expenses only went up 9.5% year over year.
Only 9.5%. That's less than half the rate of sales growth.
Precisely. That's the proof of control. SG&A dollars hit $5.7 million.
And as a percentage of sales, that must have dropped.
It did, significantly. SG&A as a percentage of net sales fell from 32.3% last year down to 28.8% this quarter.
Okay, so they weren't just riding a demand wave. They were actively managing costs.
That's the takeaway. They managed discretionary spending, streamlined things. It maximized the benefit of the volume recovery. This whole pivot from losses and restructuring to efficiency and profit, that's the core story the market latched onto.
A very compelling turnaround story so far. But okay, turning red and black is one thing. Investors always want to know what's next.
Right.
And this is where that strategic collaboration with Lightera comes in. It was announced back in early July, and you have to think this factored into the market's optimism about the future.
No doubt. It's the strategic kicker. The stated goal is pretty clear. expand OCC's product range, especially for enterprise and data center customers.
Which isn't historically their absolute core, right? They're known more for the heavy-duty military type stuff.
Exactly. Severe duty, military, specialized structured cabling. That's their heritage. Lightera brings products that give them more depth in, let's say, commercial buildings, high-density connections. Think data centers.
So it lets them offer a more complete package. They can go into an existing military or industrial customer maybe and offer more of the standard enterprise stuff alongside their specialty cables.
That's the idea. They've combined parts of their product portfolios. OCC can now sell select Lightera products. For big projects, customers often want a single source for a broader range of connectivity. Now OCC can be that source more often.
And the way they structured this deal seems key. Lightera didn't just sign a partnership agreement, they bought into OCC.
That's crucial. Lightera took a 7.24% equity stake in OCC. That's significant.
Yeah, 7.24% isn't trivial. That aligns incentives, doesn't it?
Perfectly. Lightera isn't just thinking about sales commissions now. They care about OCC's stock price. It pushes everyone towards genuine cooperation, cross-selling, sharing sales channels, making it really work. It's not just a handshake deal.
Management sounded pretty upbeat about it on the call. Confident it provides additional growth opportunities, going to accelerate sales growth, even if they didn't put hard numbers on it yet.
Understandable. It's still early days. But we did hear some signs of immediate action. Apparently, OCC people were already working the Lightera booth at the recent Bixie trade show.
Okay, so they're not wasting time. They're hitting the ground running with the joint offering.
Seems like it. Quick integration.
All right, let's widen the lens a bit. Investor context. What's happening with overall demand? Is this just OCC executing well, or is the whole market lifting?
Feels like a bit of both, based on the call. Management said they're seeing strength in their target markets, some general market improvement overall.
And specifically?
They called out continued good trends in their traditional strongholds, military, severe duty applications, but also, importantly, improvement in the broader enterprise market as well.
Okay, so demand seems solid. What about visibility? How does the backlog look heading into Q4? It was $7.1 million, right? Down just slightly from $7.2 million in Q2.
Yeah, a tiny dip. And management addressed that directly. They were very emphatic.
What did they say?
They stressed it was purely about the timing of shipments within the quarter, not a sign of weakening demand. They pointed out the backlog, the forward load, is still significantly higher than it was at the start of this fiscal year.
Okay, so near-term momentum looks intact based on that backlog.
That was their message, yes. Visibility seems okay.
Which brings us back to capacity. If demand is improving and Lightera might accelerate things, can they handle the growth? Did they talk about needing new investments?
They did. And this is really good news for that margin story we discussed. Management basically said they believe they have the existing capacity needed.
Really? So no big CapEx plans announced?
Nope. No plans for significant new equipment investment. They mentioned needing to staff up, hire more people as volume increases, sure.
But the physical plant is okay.
Yes. They benefit from having maintained excess capacity. They actually put a number on it, around 50% utilization roughly, based on machinery and standard shifts.
Huh. So they've been running pretty far below potential.
Which, again, explains the margin drag in the past, but highlights the potential now. That flexibility is key for them, too, because they do a lot of high-mix custom orders.
Right, not just churning out miles of identical cable.
Exactly. Having that spare capacity lets them take on those complex, often higher-margin custom jobs without needing to immediately rush out and buy new machines. It makes that 31.7% gross margin seem more sustainable, maybe even expandable.
Got it. Okay, one last big topic everyone asks about these days. AI, hyperscale data centers. What's OCC's angle there, especially with Lightera aiming to boost their data center presence?
Yeah, they tackled that one. They acknowledged the AI boom is lifting the whole industry, which is good.
Yeah.
But they were also realistic.
How so?
They clarified that OCC's core products, the really specialized stuff, are a better fit right now for what they call Tier 2 and Tier 3 data centers.
Meaning smaller, more specialized facilities, maybe secure government data centers, things like that.
That's the idea. Less the massive hyperscale cloud providers who tend to buy huge volumes of very standardized, often lower margin fiber. OCC's strength is in the complex structured cabling, the tough environments, the custom builds you might find in those Tier 2, Tier 3 sites.
So they expect some indirect benefit from the AI wave, but it's not their main playground yet.
Correct. The Lightera partnership is their direct path to deepen their data center exposure, but likely still focused on solutions that leverage their specialized capabilities and higher margin profile rather than just commodity fiber.
Okay, that makes sense. Let's pivot now. We always wrap up with our "This is not financial advices" segment. Time to pitch an outrageous but maybe plausible trade idea based purely on what we heard on the call.
All right, let's do it. The setup here is pretty straightforward, isn't it? OCC pulls off this dramatic turnaround. They prove they can turn higher sales volume into much higher profits because of that operating leverage.
And the market rewarded them for it. Stock got re-rated heavily. Plus, you've got the Lightera deal as a growth kicker.
But we think the market might still be underestimating the power of that combination, the multiplier effect.
Okay, lay out the trade thesis.
It hinges on this. SG&A costs seem pretty contained, right? And capacity utilization is still only around 50%.
Lots of room to grow without huge new costs.
Exactly.
Yeah.
So every new dollar of sales, especially potentially higher margin sales coming through that Lightera channel into enterprise and data centers, a huge chunk of that should drop straight to the bottom line.
Pushing margins even higher than the 31.7% they just reported, maybe past their recent peak.
That's the bet. Their previous recent high was, 33.5% back in Q4 last year. We think they could push well past that, maybe towards 35% or even higher, consistently with the Lightera mix.
So the pitch is,
Go long OCC. The thesis is the stock deserves a re-rating to a multiple you'd see on specialty manufacturers, consistently hitting 35% plus gross margins.
and the tactical bet, what's the catalyst?
The bet is that they convert the current strong backlog and the initial Lightera traction into a blowout Q4.
Yeah.
Maybe they report, say, CVRA 10 cents in EPS next quarter.
10 cents. That would be a big jump from 4 cents.
It would. And we think that kind of number could drive a really quick move in the stock, maybe up towards $15 a share or more, as the market fully buys into the sustained margin story.
Outrageous but plausible fits the bill. Okay, so wrapping this up, what's the big picture takeaway for you, the listener?
Well, OCC's Q3 was definitely defined by that clear return to profitability. Strong sales growth met operating leverage, and the bottom line really benefited.
And the later deal isn't just noise, it's a significant strategic move backed by that equity stake aimed right at growing in enterprise and specialized data center markets. It fuels the what's next story.
Keeps the momentum going.
So the final provocative thought we leave you with. Management sees a broad market recovery happening now. They hit nearly 32% gross margin before really integrating Lightera.
Yeah, think about that.
How quickly will the market price in the potential impact of Lightera scaling up within that underutilized factory, especially if utilization starts creeping towards, say, 60%? Where do margins go then? Something to ponder. And just the standard reminder, this was all for educational discussion. It's definitely not investment advice. Please do your own research.
Absolutely. Thanks for diving deep with us today.